You're seeing some money being pulled out from the fintechs and put into the banks. We'll see if they can continue to keep up these exorbitant customer acquisition initiatives. It's the small to mid-sized fintechs that I think are going to have a much tougher time, and I think you might see some fallout. The most common, I'd say, criticism that I hear about fintechs, particularly from incumbents, is that fintechs have never operated in a down cycle, right? You know, a lot of these fintechs were founded, SoFi was founded in 2011, right? They weren't around pre-08-09 crash. So they haven't had to go through that extreme down cycle, period of uncertainty, systems getting jammed up, people, putting a run on their money in the banks, all these kinds of things. Now we're starting to see some of that. The good news is that these fintechs had a lot of time to build up sizable war chests. Not all of them, but some of the major players. You can see some of them listed here. SoFi, Chime, Simple, Robinhood's another major player. And we on the show have somewhat criticized the extent that fintechs have been willing to pay to acquire customers very aggressively. Like SoFi spending $400 million for a 20-year contract to sponsor the LA Rams football stadium. I don't know if SoFi is so happy with that contract right now. There are reports here that Robinhood maxed out its credit line in the month of February. They drew its full $200 million credit facility. These companies are still paying over 1% interest if you just keep your money in their account. It's unprecedented. Marcus is also doing this. I think Marcus is still paying 1.6 or 1.7% interest if you just keep your money in Marcus. It's not even in a CD. You don't even need to have it locked up for a certain period of time. These companies and the Fed funds rate is 0. So that means that they're coming out of pocket for this. I mean, it is a big expense to pay this just off the bat, right? They're paying over 1% interest on your money just because, with no long-term commitment to even stick around and use the service over the long term. These are serious expenses, not to mention the other long-term expenses like sponsoring a football stadium for $20 million a year. These things add up. Not to mention that people, what the big banks will say, like I think Citigroup, yeah, they're benefiting from a flight to quality. That's a classic incumbent phrase, right? You're going to take your money out of the fintechs and you're going to put your money in the banks that you trust. Honestly, there's some truth to it. You're seeing some money being pulled out from the fintechs and put into the banks. And, that's some of what they're saying why Robinhood had to draw down the $200 million credit line. Now, in Robinhood's defense, they've said they've paid back the credit line. There's only a short-term credit gap for them. And so they're not continuing to draw down the line. Okay, that's what credit lines are for those intermittent cash balancing that you need done. But I think the big fintech players, the ones on this chart, the Robinhoods, I think they should be okay. We'll see if they can continue to keep up these exorbitant customer acquisition initiatives. They might want to tighten the belt on some of those, but I think they will make it through this. I think the smaller fintechs are the ones that are going to have a tougher time here. Maybe they haven't been able to build up as deep of a war chest as the really large players here. Maybe their infrastructure isn't as strong. Even Robinhood has seen now 3 major outages just in the past few weeks because people are trying to trade so much, either get their money in or get their money out. And we've seen the system stall. In the past, we've seen Chime stall, right? You've seen system outages. SoFi, for example, one of the big players, they raised $500 million in May of last year, 2019. But they had not raised around prior until Q1 of 2017. They went 2 years until they raised a $500 million round. Now, these are the guys that did the $400 million deal for the stadium. That's only $20 million a year, only $20 million a year. But still, I hope they haven't burned through the $500 million. I'm pretty sure they're going to have runway through 2020. They will be able to make it through this. They should be able to. It's the small to mid-sized fintechs that I think are going to have a much tougher time. And I think you might see some fallout. Yesterday on the show, we were covering an article that was starting to list off some of the startups that have already started to fall victim to coronavirus. We've already started to see some closures. we've covered now a few times on the show. There's a huge issue and pain point for startups in general, with VCs starting to be much more reticent to continue to see through fundraising rounds and are starting to revisit their strategies on investing. So will the classic incumbent ethos that fintechs have not been through a down cycle? They have not. Well, now they're in the down cycle. So what's going to happen? I think the small to mid players, you will see some emergency situations where they start to aggressively cut programs or incentives that they had been giving. You might see some closures. You might see some down rounds as they become desperate to shore up some capital and make it through this period of time. Hi, this is Alex from Winner Take All. Thanks for joining us. Hope you enjoyed the content. Feel free to leave a comment, ask us questions, and definitely make sure to join us on our next live stream.